Mega caps have dominated gains this year, but could small caps be the sleeper bet of the summer? The small cap Russell 2000 index, it has risen more than 7.5% this year. Not as good as the S&P or the NASDAQ, but it has been gaining momentum as of late. So let's talk about what we could see from here. Let's bring in Quincy Krosby, LPL Financial Chief Global Strategist, to weigh in. So Quincy, I know that small caps are among the areas that you are watching. It's good to see you. Do you think that this is an area where investors should be looking right now as they await the maybe coming broadening out of the rally?
Well, we're just following the small and mid cap as a barometer, not necessarily as an investment, but clearly it is helping at least assuage fears that this market is only being led by eight mega cap stocks. The other thing about the small and mid cap is that the risk profile is actually riskier and more volatile than the S&P 500. So when you see a turn, and it's been on a number of days, it's not just, a one-off. They'll become overbought, they'll rest, and then they'll come back. But it also suggests that, as you alluded to, the small and regional banks that populate the Russell 2000, that at least for investors, and by the way, we believe this is being led by managers, portfolio managers, that they believe the worst is over. Because if you didn't believe that, you would certainly not see the advance in the Russell 2000. So that's a positive. The industrials in the Russell 2000 also performing well. Even on the large cap basis, the industrials have been leading the home builders, the defense stocks, machinery, infrastructure names, helping the industrials do very well. They've been sort of the engine that could in this rally, x the mega cap names. But the small and mid cap, they are volatile, and if they start to suspect that we are close to a recession, they will sell off very, very quickly. So again, as a barometer of what is being signaled by that Russell 2000, it actually is quite positive at this point.
Quincy, when you spoke about some of the portfolio managers who were kind of forced to participate in the tech rally and the mega tech rally, does that also mean that those same portfolio managers will then trigger perhaps some significant downside movement if they're forced to now rotate back into small caps?
Well, I don't think that it's so, the channels are so differentiated. I don't think they're going to go into small and mid cap. But the fact is that when you get to the end of a quarter, when you get to the half year mark, if you are lagging in performance, you are going to go into the leadership, and you're going to do it regardless of your commitment, regardless of your conviction. You are going to go in. And if you don't go in, your risk manager is going to tell you, you can't be lagging this much. So normally what we see toward the end of the quarter, or the half year, especially the half year, is this push in. The big tell will be actually when we come back after the 4th of July, when the trading desks are filled, whether or not these managers stay in the now high valuation part of the market.
Do you think that folks should stay invested here, or where are you recommending that people go in this market?
Well, we still like fixed income. We like the short duration part of the treasury market. You can still get over 5%. We like preferreds, particularly on the large money center banks, especially after the stress test came back, that they are all passing and doing well. And then in addition to that, in investment grade corporates, those are attractive, again, short duration. People have been saying, Quincy, what about the high yield? Well, the high yield spreads are actually pretty tight, considering that the headlines have been screaming recession. But why take on that risk at this point? We suggest going into the high quality names, but certainly the industrials at this point. By the way, if we do hit a recession, statistically, the industrials actually start to pull out first, as the market sees rates coming down and the Federal Reserve beginning to think about cutting rates.
Quincy, you talked about why taking on the risk in high yield in particular. Are there areas in the market where you do think it is worth taking a risk? Are there sort of higher beta areas that are interesting to you?
Well, we are not advocating this by any means, but I can share with you that many portfolio managers are looking at the fallen angels. They believe that the fallen angels are offering an attractive yield, and that we are close to the end of the Fed rate cycle. Most likely at this point today, we're seeing, yes, still a rate hike for the 26th of July, but for the September meeting, the odds of probability has come down a bit after today's report. So that would suggest that if it continues to show that the core PCE deflator continues to come down, maybe the Fed does not come in September. But again, the beneficiaries will be the fallen angels, because they're pretty good companies. But again, if you are thinking that there's a recession coming and an impending recession, you are going to be very leery of it. So we're being conservative. We are in kind of watchful waiting, and we're happy with our architecture, so to speak, going into the second half.